If you are retired and need $150,000 this year for living expenses, which account should you spend first? Most retirees think it doesn't matter. Of course it does, because the wrong choice could cost you over $15,000 in unnecessary taxes. Hey, I'm Amber, a retirement planning specialist here in Seattle. Today, I will show you a simple withdrawal strategy that can help retirees keep more of their money and send less to the IRS. To make this easier, I group retirement assets into three simple buckets: the wallet, the IOU, and the vault. The wallet. This is your brokerage account. You have already paid taxes on the money you put in. If your investments grow, you may owe taxes on the gains when you sell. Think of it like cash in your wallet. It is flexible and easy to access. The IOU. This is your traditional IRA or 401k. The IRS gave you a tax break when you did your contributions. But someday, they want their share back. That's why I call it the IOU. Every dollar you withdraw is usually taxed as ordinary income. And finally, the vault. This is your Roth IRA or Roth 401k. You already paid taxes on the money that went in. In return, qualified withdrawals are tax-free. Once money goes into the vault, the IRS is basically knocked out. So now you may be wondering, to maximize the benefits, which bucket should I spend first? Spend the wallet first. Tap the IOU second. Save the vault for last. But why spend the wallet first? Because the other two accounts have a special advantage. They can continue growing and compounding without a tax drag. Think of your IOU and your vault as a greenhouse. Once the money is inside, it can continue growing and compounding without a tax drag. Your wallet is different. It sits outside the greenhouse. Every time you sell an investment, taxes may come into the picture. Now be fair, the wallet does have one advantage. Long-term capital gains often receive favorable tax treatment, and in some situations, may even be taxed at 0%. We will see an example of that in a bit. But generally speaking, many retirees still choose to spend the money outside the greenhouse first. That allows the IOU and the vault more time to grow and compound. So, simple rule, spend what's outside, giving what's inside more time to grow. Let's meet Scott and his wife. They just retired and need $150,000 for living expenses this year. Let's look at the scenario A. They withdraw the entire amount from their IOU account, so that $150,000 becomes the taxable income. As a result, part of the withdrawal falls into the 22% federal tax bracket. Depending on their situation, they could owe roughly $15,000 in federal taxes. Let's try scenario B. Instead, they sell investments from their wallet. Of the $150,000 they withdraw, $20,000 is their original principal, and $130,000 is long-term capital gain. Assuming Scott and his wife have little or no other taxable income, that gain may qualify for the 0% federal capital gains rate. So, same $150,000, one withdrawal strategy could cost Scott and his wife about $15,000 in taxes. The other could potentially cost them nothing. The benefit here isn't just saving taxes today. It also gives you IOU and the vault more time to grow and compound inside the greenhouse. At the same time, it may create planning opportunities, including Roth conversions. During low income years, Scott may choose to move money from the IOU into the vault. Over time, more of his retirement assets can shift into the vault. That's why withdrawal order matters. It's not only about saving taxes today, it's also about reducing taxes in the future and creating more flexibility along the way. Now, before you start spending down your wallet, there is one important thing to understand. Retirement planning is never one size fits all. The rule we just discussed works well in many situations, but there are times when a different withdrawal order may make more sense. Let's look at 3 common situations where it may be worth breaking the rule. Let's look at one common opportunity during lower income years. Scott decides to retire at 62. He plans to delay Social Security until age 70. His required minimum distributions, or RMDs, won't begin until age 73. That creates an 8-year planning window. During those years, Scott may have a relatively smaller taxable income that may allow him to move some money from the IOU into the vault through Roth conversions while staying in lower tax brackets, such as 10% or 12%. The goal is simple. Pay a little tax now instead of potentially paying more tax later. The second situation is a major one-time expense. Let's assume Scott has already covered his normal living expenses using his wallet. Then something unexpected happens. He needs another $130,000. Maybe it's a new roof. Maybe it's helping a child buy a home. Maybe it's a large medical expense. The question becomes, which account should he tap next? Let's look at 2 possibilities. If Scott withdraws the entire $130,000 from his IOU account, every dollar becomes taxable income. That could push him into a higher tax bracket, potentially as high as 22%. But taxes may not be the only consequence. That spike in taxable income may also increase the Medicare premiums in future years through something called IRMAA, Income-Related Monthly Adjustment Amount. Another option is to use assets from his vault. Qualified Roth withdrawals are usually tax-free and do not increase taxable income. That means no additional federal tax bill and 0 impact on future IRMAA premiums. So, same expense, same $130,000 withdrawals, but one choice may increase both taxes and the Medicare premiums, while the other may avoid both. Let's look at one more situation. Scott may not need every dollar sitting inside his IOU account, and he knows those money may eventually create larger RMDs in the future. One option may be repositioning a portion of those assets into guaranteed income for life. That can provide a predictable income regardless of market conditions. And because a portion of the IOU account has been repositioned, it may also reduce future RMD pressure. Not every retiree will choose this approach, but it highlights an important point. There is more than one way to manage your retirement income and future RMDs. The goal is to make it as tax efficient as possible while supporting your retirement income needs. So, what's the takeaway? Most retirees can start with a simple rule. Spend the wallet first, tap the IOU second, save the vault for last. But retirement planning is never one size fits all. Lower income years, large one-time expenses, and future RMD planning may all justify changing the sequence. The goal isn't just withdrawing money. The goal is withdrawing money from the right account at the right time. That's how you keep more of your money and send less to the IRS. If you are retired or getting closer to retirement and you are not sure which account to spend first, feel free to reach out. Thank you for watching, and I will see you in the next video.